Good morning, everyone. I think we'll make a start. Welcome. My name is Charles Human. Welcome to the session, which is called X-Raying Deals. Who are the deal makers and what are the deal breakers? An update on M&A transactions, what is next on the cards. Let me introduce my panelists. From my far right, Carl Badstuber, who is Senior Hotel Specialist at AXA Real Estate. We've then got Bruno Join, Managing Director of BNP Paribas Real Estate Hotels. Lionel Benjamin, who's Director of Hotels at Topland. And Mathieu Everard, who is Chief Development Officer of Louvre Hotel Group. I'm going to kick off with a few slides to set the scene about the transaction market in Europe. So this graph shows total transaction volume going back to 2005. It shows that in 2014, total transaction volume was 14.4 billion, which was the largest level seen since 2007, up 86% in total on 2013. So a strong year. Single asset activity was half of that at approximately 7.5 billion, which is the highest level of single asset transaction activity on record. In total, well above the long-term average. Where have the transactions been taking place? The bulk have been taking place in the UK for 2013, and the same trend has been seen going back probably the last 5 years. So 35% of total activity in the UK, and I think that's driven both by sort of supply and demand factors. There's more available and there's more appetite. Followed by Germany, 15%, France, 12%, and still, I don't know if it's surprising or not, but still very low levels of activity in Southern Europe, very little in Spain and Portugal and Italy. Who's buying? It's a very different profile between single assets and portfolios. On the single asset side, the largest category is what we classify as a real estate investor, which is, I think, is a Topland would fit into that category. So it's a group that is active in all types of real estate and is not private equity, but is not a REIT. So private equity 11%, institutions 20%. So pretty broad. And when it gets to the bigger deals, the portfolios private equity dominates, and that's one of the changes we've seen in the market. Private equity, particularly US driven, is bigger is better. So they're chasing the larger deals, and that's a trend that has changed in recent years. And then also interesting is the reemergence of the operators as buyers of hotels, and Accor have been, I guess, leading the way on that as a reversing the asset light strategy. Where's the money coming from? It's predominantly coming from Europe still, but that is changing quite dramatically. Now down to under half of investment is from within Europe. Strong increase in last year of US originated money, and this is the private equity funds. And then Asia at the top, we're seeing a pretty strong surge in Asian capital coming to Europe. Private equity investment, this is interesting, peaked in 2007 at 7.5 billion, then very, very low levels as the market turns down, harder to raise funds, harder to leverage deals, and then a big pop 2014 as some very substantial deals get transacted by the PE funds. Same story of, I think the big growth spot, if you like, is Asian capital coming into Europe. So very low levels 4 or 5 years ago, up to nearly 2.5 billion of Asian, much of it Chinese money investing in Europe. Who's selling? It's very diverse. I think the one key trend that can be seen from this is that there's very little distress selling at this point. That's mainly flowed through. So on the single assets, it's probably less than 10% that's true distressed, and less than that on the bigger sales, but pretty broad. And interesting that private equity is the biggest buyer, but also the biggest seller. And this is the funds that were invested pre-downturn that have pent-up need to sell, that are selling at this point. Top 5 buyers, Jinjiang bought Louvre, Hotel Invest, Goldman Sachs, one deal in the UK buying a portfolio of Travelodges, KSL in the UK, and Constellation out of Qatar buying a series of assets. So those are the top 5 buyers. Top 5 sellers, Starwood Capital, interesting, who've also been a big buyer. De Vere selling out of the UK. Moorpark selling their Accor portfolio in Germany and the Netherlands to Accor. And then Prespri, who were the sellers of the portfolio that Goldman Sachs and others bought. And Ivanhoe Cambridge selling in Germany. So those are the most active players. And then cap rates. So this is interesting. This is data taken from the RCA database, and it's the relatively few transactions in that database have cap rates reported, and many of those that do are leased hotels. However, I think that the trend here and the numbers are quite representative of what's really happening in the market. So it shows back in 2007, average cap rates at sort of a bit above 5.5, starting to rise as the market heats up, peaking at the sort of low point of the downturn, 6.75, and then as capital looks to invest and people start to buy into the recovery, cap rates fall, which is exactly what happened. People were buying off low cap rates, which reflected the earnings uplift potential in a hotel, and here we are today at cap rates in the sort of low 6s. And I don't know we'll see what other panelists think, but I would say that is pretty representative of not just leased hotels, but also operating businesses and managed hotels in good European markets. So that's a quick overview. Lionel, why don't you kick us off? You're not a newcomer as a group, but because I remember you bought a portfolio of Thistle leased hotels back pre-downturn. You're a broader property player in the UK. You've made a very significant move into the UK regional market over the last 18 months. Why don't you tell us what you've been up to and why and rationale?
The Topland Group, as you say, primarily a real estate company, and hotels were purchased as part of good leased income. The fact that they were hotels was very much a byproduct of that. And as the yields in commercial real estate began to compress, we felt that there was an opportunity where hotels offered the bricks and mortar to a real estate company, offered the cash flow, and the availability of the deals at the right yield was certainly still available within the UK, specifically within the provincial markets, where the UK had suffered tremendously post the crash. The provincial market took the biggest hit from that. And in 2013, when we started inquiring into the market, we were able to secure our first portfolio transaction of hotels that we decided we would operate ourselves, and purchase the Menzies portfolio, 12 hotels, 1,200 bedrooms in provincial UK. And that was November of 2013. Our strategy is very much to turn the businesses around. I think one of the points that we were discussing, pre-sitting at the panel was acquisition is a process that takes 4 weeks, 8 weeks, depending on who's buying. Topland's approach has been very much textbook Topland, buy for cash, do a deal within 4 weeks, and secure the deal because we can act quickly and for cash. And once that deal's done, we've then, being a family company, not got the same parameters of the PE companies in terms of the exits that you were talking about, Charles. So for us, we're holders, and it's about the turnaround, and it's about how you then grow that business and add value so that we can take them further forward, refinance them, fund them, etc. In August of last year, we managed to secure another transaction, the Hallmark portfolio, another 8 hotels, again off market and for cash. And in January of this year, 22nd of January, we added another 8 hotels to the portfolio. taking us to 28 that we own and operate, 29, sorry, we bought the Royal Crescent Hotel out of Von Essen as well. So we have 29 hotels that we own and operate, and 28 of them purchased in the last 13 months. Our strategy moving forward is still further acquisition. London, UK markets are getting hotter and hotter because the private equity, the Chinese money coming in makes it more challenging for us to get the kind of deals that would be of interest to us. We feel that continental Europe today is offering us more growth potential. So we're looking further afield. The fact that the UK and Germany has had good activity means that for investors like us, the opportunity is probably more in Spain and Portugal and other parts of Southern Europe. So we'll be looking to further grow the business through investments in continental Europe. That's pretty much where we are to date. We're working to consolidate the existing portfolio, make sure that we're growing the EBITDA, because without that, we're really nothing. There's no value if we can't drive the EBITDA, so that's a really key focus for us in our business. We're very granular in that detail on the asset management side of how we operate. And the exit strategy is not something we really talk about too much. It's there, it's on the back burner, but the focus is very much consolidate and further acquisition. And that acquisition, if we can't get the right pricing for us in the UK, means move to Southern Europe or further afield, or keep the powder dry.
Talk about that in a minute. Carl, you have a slightly different approach. Why don't you tell us what you've been up to?
Yes, of course. Well, good morning, everyone. Maybe just a quick introduction. I joined AXA about a year and a half ago. I worked before for nearly 5 years for Morgan Stanley, and originally I come from the field, meaning I started off in the hotel itself, which meant I started with Sheraton, worked many years for Intercontinental and for Starwood. So I feel I got quite a good blend of experience on the hotel side. AXA, maybe not everyone knows, but AXA is clearly one of the leading hotel owners and investors in Europe. We have about 80 properties as we speak. At the moment, dominantly in France, and about 50 plus in France, and the rest across Europe. In terms of hotel categories, maybe in simple terms, we have about 1/3 upscale and luxury property, and another third in terms of mid-scale, and remaining third on the budget. Categories are really, we have all type of hotels. In terms of value, currently we have nearly 1.9 billion, these 80 hotels. And if you look at that in terms of lease and management, you could say about 70% lease and about 30% management. In terms of investors or clients, as often one says, we can do single assets, we can do small, we can do large portfolios. We have different pockets of investors, meaning they can acquire core properties with a lower return, or core plus, or value add, or of course opportunistic as well. Having quite a few properties in France, of course, we are very happy to add additional properties in Paris, but we would say our main focus would be in Germany and in the UK. But also we are keen and very focused on Italy and Spain. We are a little bit less on Eastern Europe. It's got nothing to do maybe with current events. We have not really invested over the years into Eastern Europe, and we have not really invested outside the wider European spectrum. So that's a little bit of a landscape sort of where we are and what we do. And maybe some of our recent acquisitions, which one Charles knows very well, which is a little while ago now. about 18 months, which is the Krasnopolski in Amsterdam, which really is, for us, falls into the value add category, where we say this property, there's a clear story. We're also doing an extensive refurbishment to reposition the property in partnership with NH. Another acquisition we did was in Stuttgart. It was like a hotel and office. And probably the most recent one, which was middle of last year, was the Park-In at Heathrow Airport. That's an 895 bedroom property, the closest to Terminal 1, 2 and 3. So, which shows we can do different types of investment, and one was with a management contract, which is the one in Amsterdam, and the other two were on a lease contract. That may be a little overview who we are and what we do.
So for your separate account business, meaning where you invest with a partner, is the profile of that investor changing, both in terms of risk profile and geography? Is it more core, more value add, more Asian, more European? How's the profile of that in terms of capital attracted to the hotel sector in Europe changing in your view?
Well, obviously, I think everyone knows you have all the non-European coming in a lot stronger. We have many of them, or some of them, maybe is the better word, are our clients. We work with them. We do joint ventures as well. If I take the Krasnopolski, which you know very well, Charles, there it was the investment, a 50-50 joint venture between, let's call it the wider AXA family, one of our AXA funds, and an Asian investor. But we work very strongly with several American, US separate accounts, and where either we combine them or depending on the destination, on the contract of the property, sometimes our sort of own funds acquire it. We also, maybe that's worth mentioning, we also buy full equity. Depending which investor is or showing interest in the property, or of course we do with debt financing. So there are quite a few combinations we can look at, and we can then execute the deal.
So Mathieu, you're under new ownership, so to speak, as a result. So can you tell us a bit about sort of what happened there and how so you're now in Asian hands and how that's affected?
Yeah, so first of all, closing was last Friday.
Wow.
Okay, so it's really recent.
Well done.
And indeed, it's changing a lot because we spent the weekend touring Tour Eiffel, Galeries Lafayette, and Champs-Élysées with our new shareholders. So it's, the strategic discussion has changed a lot so far. And
so a bit of background on them. Xinjiang is they are what?
So Xinjiang is actually a state-owned conglomerate based out of Shanghai. So it's owned by the Shanghai government. They operate and own a lot of different businesses in the travel industry. So they own the biggest taxi fleet in Shanghai, leasing car business. They are the main private owner of the new Shanghai Disney Shanghai. And they also own some real estate, and part of their business, they own Xinjiang Hotels, so it's 1,200 hotels in China on the budget, mid-market, selected service brands, and about 60 hotels in the luxury assets. So it's really a big conglomerate. It's listed in two marketplaces, Hong Kong and Shanghai, both. And they acquired Louvre Hotel 100%. So I was joking, but it's really what is really changing now is we are really creating the relationship with our new shareholders. They are not really here for short term, so they want to create a good relationship with the management team. And it's more important than discussing the new strategic decision. But I think it's going to come at some point in the coming weeks. The new real change is we don't have the shareholders in our offices, and they are a few hours away from us. So we need to create this trend of confidence on how we would deal the business, and they are really here to learn from us. They request for some of our people to go to China, to bring the brand to China, to bring some know-how to China. They are also keen to deploy more capital in consolidating the European market. They have a strong vision also on investing in distribution and technology and all the electronic new hospitality challenges. So I think it's very good for the company to have this capital stabilized and with a long-term vision.
So that transaction has been one of very few large platform plays outside the UK. There's been a lot of UK activity, but outside, and really the only large French regional transaction. Do you think, do you see both your group and others doing more large-scale portfolio activity across Europe over the next 12 months?
Yeah, I think that's one of the strategic guidelines of Xinjiang is the consolidation of European platforms. In the past, with our private equity shareholders, the cost of the balance sheet was very high, and we were playing only in small, very high-yielded transactions with the capacity we have. This acquisition has been fully funded on equity, so they issued some bonds in Asia to raise the acquisition price, but it has been fully funded on equity in Europe, so it would give some free cash flow for the company to invest in larger transactions. And as you know, the profile of Louvre Hotels is really strong and big in France. And we have a smaller portfolio, UK, Benelux, Spain, Germany is coming. And we really want to be one of the big player for the consolidation of the market.
And they're in it for the long term, unlike
Yes.
many of the buyers today.
Yeah, they're really here for creating a big platform. It's not buy and build businesses, long-term hold.
So Bruno, we've in the UK we've seen a lot of portfolios transact over the last 3 years, and virtually nothing in France. There's been activity in Paris. We've handled a number of sales there, but regional, unless it's sort of below the radar screen, regional France, apart from this transaction, has seen very low levels of activity. Is that has more happened? Is it about to happen? Where do you see the trend?
Actually, it did happen. We sold a portfolio on behalf of LFP, 26 hotels in the region. But if I have to come back, I would say that 2013 was definitely the warm-up stage for investment in continental Europe. 2013, and 2014 looks really interesting because, yeah, we see this flow of international investors coming from Asia, coming from the US, but most of them just remained in the Paris vicinity, and the region and other key gateways in Europe remain just in their second thought when it comes to hotel investment. And luckily, what we've seen in 2014 is that the region are warming up. If you look at the yield you're getting in Paris, you are in this same trend that you have in London with this gap between London that will still exist in 10 years' time. But we are at the present time at a yield of 4.50% in Paris. And there is no reason for me to think that is going to change, and we can expect in the forthcoming months or year to have this at least shrink by 50 bips. So all those investors are right now still motivated in France, but Paris is becoming extremely expensive, and that leaves that to really sovereign funds or investors coming from Asia, which are willing to invest in Europe for other reasons than only the EBITDA, as you mentioned. earlier, and these investors are starting to look at the region as a way to expand. So last year we had this portfolio of 26 hotels which was sold to Swiss Life Real Estate, so international, foreign investment in region does exist in 2014.
So these were leased hotels, or what was the operating structure?
There was a franchise portfolio of Louvre Hotel under Campanile. That was maybe the first hit before Yin Yang, making the region in France a very good destination. And not only for region in France, the other destinations such as Belgium or Italy or Spain are starting to come back on the radar. What was interesting last year is we had this enormous amount of hotel investment in the UK, but one thing was quite new last year in Europe is for the first time investment in Germany overtook what you had in France, and basically we recorded 2.2 billion euro in France and 3 billion euro in Germany. And that is interesting because when you look at what are the keys of the German market, is you're definitely looking at as a lease market. It's interesting to see what are the reasons all those investors are coming, believing that the hotel performance are on an upward curve, but still looking at a Germany which is a typically lease market. Yeah, security, flying to security. So it's still a component which is important, and you mentioned it earlier. You still want to keep the value of your asset to something that has to talk about with the EBITDA, with the day-to-day operation, or you can flee to for security with a fixed lease, no hassle. Whatever happens, I'll get my cash.
So Paris cap rates 4.5 sounds about right to me.
That was, yeah.
Regional France.
Well, that's where there is an opportunity to come to France, because I heard 5.5% for the region in UK. Well, welcome to France. We have a higher, it's a bit more. We're still in the vicinity of 9%. That is on average. If you go for certain assets in the major cities, I wouldn't be surprised if we see some asset going for 5.5 up to 6.5. But in general, you will go for a 9% on average. Then location, branding. And competition will definitely have a say when it comes to what will be the final yield that will be used. But that's.
Where do you think UK regional is now, Lionel?
I like the idea of it being sub 5.5, but I don't think it really is. I think where we are.
But it's sub 8. It's sub 8.
I like that, but it is sub 8. Not too far below that though. And we don't want it to get too far below that, otherwise we'll have a resurgence of what happened previously. So we've got to keep things into some perspective. We're all looking at the upside, and when we're all talking to the banks and we're talking to businesses, we talk about hotels gradually growing and growing. But it's not true, is it? Because we know that this happens, and when this happens, we need to be in the right position. And if we're paying sub 8, sub 7 yields, when the curve does go the wrong way for us, we're going to be back to where we were 2007, 2008. So I think we need to put things into perspective. London, different market, Paris, different market. The provincial hotels, when we talk about the rate growth and RevPAR growth that we've seen in the provincial hotels, and they've got back to 2007 levels in UK provincial cities, the profitability of the business hasn't got to those levels in percentage terms, because from 2007 to 2015, costs have gone up. So business rates, insurance, etc., etc., etc. So to actually get back to those profit levels that will justify paying the lower yields, there's still a bit more time to come.
I would say, I'm interested to hear your view, that regional UK, in fact I would say all European markets outside London and Paris are still some way, in value terms, value per room terms, still some way below the previous peak. And I think for exactly the reason you've just outlined.
Yeah. Well, they are, and I think that, as Bruno says, I think that's why for us the opportunity now is more to look further afield. Unfortunately, with the PE companies and the Chinese wealth that's coming in, when they compare in China the yields that they would be buying in a provincial area, it's sub 4. So coming into the UK in a stabilised environment where there may be leases in place or where the market will still see further growth, to buy sub 8 and buy sub 7 in perspective for a Chinese investor makes the UK a very safe and very commercial opportunity. So for investors like us, private family offices, because that's really in essence what we are, the investment in provincial UK needs to grow a little further out. And when you talk about the kind of yields that you're seeing in continental Europe, in the regions in France, Spain, Italy, it becomes more interesting for investors like us to look further afield.
Well, certainly a theme of this conference is, and this is mainly focused on the UK because that's where the activity has been, but there's so much is now in the hands of the PE funds who are starting to look to, because their hold period is short, they're now starting to look to recycle. So does PE buy from PE? There's not the psychology of that isn't quite right. So two things. One is there now going to be a new flood of first generation UK deals hitting the UK market? And what does that do to pricing? And who's going to take these deals out?
I think you've asked two very, very pertinent questions. In the next, if you look at the PE, their strategy, unlike ours, their strategy is a 5-year hold and then they exit. And they've purchased so much. And we've seen the 5-year hold has really contracted. Some of you have been in other sessions, I'm sure, and have heard people talk about, KSL's approach, and it's been a 2-year hold and Malmaison's out there and ready to be sold. So who's going to buy those kind of assets? Well, when they go to those lower yields that we've been talking about, it's not going to be the UK. And PE are going to find, I think, that their returns are contracting. So how much can they keep buying when the price has gone to this particular level that makes it hard for people like us, but it also makes it hard for people like them, because how much more can they contract the return that they're going to be giving to their investors? So the opportunity goes back to foreign investment coming into Europe, where they see our yields as still being competitive compared to their local marketplace and secure. And then there's the price point. I mean, if there's going to be I work in the UK, we're focused on the UK, 2.5 billion of acquisition over the last 18 months. If that starts to come to the market in the next 2 years, how will that impact price? Will it go down? Will it go up? Because, that's the big question. I'm not an economist and I'm not going to crystal ball gaze, but the logic would say to me, if the foreign investment out of Asia still finds us competitive, then there's no need for the price to really go down if they still see the opportunity.
And of course, the other question is, how long will the regional UK growth continue?
18 months we've probably got, I think, Carl. I think we've probably got an opportunity where we're still not, we're getting close to 2007 levels, but the market's gone up and there is a strong tailwind.
You're talking about earnings growth or value?
I think both, to be honest.
Because value is driven by earnings growth and cap rates, and from my perspective, it's hard to see more cap rate compression. I think that the Chinese, except in France.
This is the place. Please contact Bruno.
No, it's interesting. I mean, clearly Europe. I think the problem with Europe right now is deal availability. Is that fair? I mean, in theory you can buy at those sort of yields, but it's where's the stock going to come from?
Well, as you said, there's a flow of investors who came to the UK and now they're crossing the channel to come to France.
So who are the sellers? Who are the sellers?
Who's the sellers? The people who were bright enough to bought it 2-3 years ago when nobody was willing to get this portfolio, and even knowing that at one point the origin market will go high because the fundamentals are good. You're relying on a domestic market that has been hit by the crisis, but I mean still want to travel in France or in Europe. We're definitely, for our point of view, at a shrinking stage, because you can, I mentioned 9%, but where this pre-investment market will be in 6 months, definitely not at 9%. I mean, things are moving moving very fast. And furthermore, you can also see that the gap between the pure lease asset market and the management contract and franchise market are also shrinking. What you get in Paris nowadays, you can have a wall or a wall plus going concern for basically the same for the same cap. So that is changing also the mentality of the investors, where risk is not anymore something dangerous, but maybe a reward, and that will maybe lead them to the region, and we definitely look forward to that.
So you're saying there's very little difference between a lease and a management
in
contract
Paris
these days?
In Paris. In Paris, yeah. In Paris, we were saying that the difference is...
and how you see it more on a wider regional level?
Well,
What would you see the difference between the two?
I would say that will all depend of who's the tenant, who's operating, and what is the guarantee that it offers. As you can imagine, if you're a nobody hotel operator, or if you're, for instance, Louvre, but I doubt you have any you maybe have some lease in place, but for instance, Louvre or Accor are brand names that will definitely appeal for typical investors. We had in France, we have a structure of REIT which is completely different than what you will see in the US, where a French REIT can hardly buy asset with the going concern. So they have to find a way that they either put in place a lease or a business lease, and that has driven the market at very low cap, because there is a lot of REITs that are French REIT which are willing to enter into this market. But as you mentioned, there is not a lot of asset on the market to fulfill the pipeline. Yeah.
So where do you find value these days? Is the low-hanging fruit has completely gone?
I think you can't say that, because there's so many still family-owned, family-run businesses. When we bought Feathers in January, this portfolio of 8 hotels in the northeast of England, around Liverpool and Manchester, I'd never heard of it. I don't think most of the agents in the UK market had heard of it until it initially had been marketed. Right, so there's so many out there where agents come and say to me, we didn't know about this portfolio. So there is still scope. It's getting harder, because why would any of those guys go off market today? So it's going to come to market, and once there's awareness, that's going to make it more challenging for the likes of us to acquire, which again means we need to cross the channel. But you have the same situation where there aren't portfolios, there aren't single assets that are coming to the market. It's still dry now in terms of transactional availability from what we're seeing. And what is coming to the market, there's unfortunately a big part when you have individual owners, as we know, who feel that there's a value on a property. Actually very emotive when they're family-owned businesses, and they believe that the price point should be here, and we believe the price point should be somewhere there. And then finding that happy medium becomes more challenging when you're dealing with private individuals. Makes it a harder transaction to see through as well. So it's getting harder. It's not getting any easier to do business in the hotel sector.
Where are you finding value, Carl?
Well, I'm echoing Lionel's what he said, and I think another slight complexity is you often hear, well, this is an off-market deal, but off-market means nowadays instead of 50 people, it's 5 people, and the 5 people are probably the same people who in the end are going to buy it, most likely. Yeah? So I think that there are some low-hanging fruits. I think it becomes, you need to work harder for it. Some people can move quicker, and we have a few little, guidelines we need to follow internally, but we can move fast. And I think you need to try and focus on certain deals which are most likely, in your own belief, which you can execute. I think there are many deals out there, and you can keep yourself extremely busy, but may not end up doing anything. So I think you have to try and tie it down and really work and get everyone, speak about our organization, on board and get everyone, online and support the deal, and then you can move forward. But you have many more competitors now.
Do you think that there is greater value to be had in smaller lot sizes, meaning that the real sweet spot of the market is the PE fund kind of 150, 200 million plus transaction? And I think we are, I don't know whether you all agree, but I think we're back in the cycle, part of the cycle where there's a premium for size. So is there greater value to be had once you've got the platform in bolting on?
Yeah, but also, I mean, there are many portfolios out there. You will get a mix. Some very good ones, some medium, and then one or two more difficult ones. I mean, we quite like, also single asset. We have various investors which say around 50 million upwards, which can move very quickly, because also if we then need to do a joint venture with investors, that moves quicker, that, keep the cost, at a different level, just setting it all up. So we are very happy to have single asset, 50 million upwards. We can go to 200, we can go further, because we have different parties who are interested. Personally, I've seen quite a lot of deals in the core plus area, around Europe.
So define core plus?
Well, the core plus is basically, it's just below the value add, meaning before the 2-digit, returns. And we have quite a couple of new, very strong value add funds who want to find value add opportunities. That proves, a little bit of a challenge. So really, it's around maybe, the 10% return. Even some of the portfolios you can see. And of course, for us, for AXA, one key point is what is the structure in terms of the partner we work. We don't really, historically, have not taken on the direct responsibility of the staff, which is normally, kept with the operator. We have done that for many years and want to continue. And there are various ways, of achieving this. And we work with many brands together, we're also there. Sometimes, you can be pointed in the direction of a potential deal.
Relationships. And that's where it is today. It's relationships, as it always has been in business, but it's more evident today. It's your reputation to deliver, it's reputation to be spoken to by people who say, right, we know you're going to come to the table, this is your kind of sweet spot, we'll talk to you, and can you come to the table quickly and do a deal? Although it is, like Carl's 100% right, it's getting much harder to do those today, because why would you? Why wouldn't you just go to the off-market 5 people?
And yeah, just to tap in line, I think it's very true, and this may sound a bit, I don't want to use the old-fashioned, but maybe a bit traditional. I think it is key to have a good network. And if there's a situation, you need to be able to call somebody.
Yes.
I mean, not a quiz show where you call somebody who will help you to answer the question, but to call someone who can assist you to progress. And I think you need to be very perseverant and determined, and to overcome, certain obstacles. There are always many obstacles, but you need to be strong, not to be knocked back, and
Are you closing?
Keep going at it.
Are you closing all equity and then putting debt on as to move quick, or are you? Traditional.
I mean, I can answer for ourselves. Traditionally not. We very much want to determine who's the investor at an early stage. That is important for the internal process. That we have the components in place. Personally, I think it's key to have the plan well mapped out at the beginning, and then try and fine-tune it. So that's how we like to operate, and then we can move, fairly quickly. And I think, Lionel, you indicated certain lines, depending on the complexity of the deal, or it's a single deal, or it's, you all know if it's an asset or if it's a share deal. All these issues, help.
But Joe, as an operator, are you seeing an increased appetite for development funding? equity and debt
In terms for new construction?
New construction? Yeah.
Well, I think it depends on the brand scale, but I would say that Europe, traditional Europe, is really more focused on existing hotel transactions. But we are we believe a lot in the budget hotel, especially in Germany or in south of Europe. So we think that we can develop a platform of premier class hotel, one-star hotel, because this is very cost efficient in terms of construction and operation. And the supply does not exist in many of the countries, so it's more construction and
So you're developing those as an owner-operator, or are you developing to lease to an institution, or how are you structuring?
We have different structures, depend on country, but in Germany, for example, we've created a small investment fund where we are managing the fund on behalf of high net worth individuals, which are investing in a platform of premier class hotels. So we are now on our fourth acquisition of land, and so it will be built and operated in the next 18 months. For other markets, for example, we develop premier class as well in Indonesia. We are more looking with a strategic Indonesian developer, creating a JV. So we are putting together our know-how and efforts in order to create this big and massive platform with only one partner. So depending on market and opportunity, we are looking at different options. Now with our new shareholder, we'll see if we're going to fund them ourselves. But I think it's going to be, for premier class hotel, it's going to be co-investment anyway, because of the volume of development and operation to deploy. We probably will allocate a portion of our own capacity into this, but not 100%.
Is anyone else seeing more appetite for development funding?
Ask the banker.
Well, in Paris, development is always a good word in destination where there is a constraint in terms of land, and definitely London or other cities such as Paris answer to that. We've seen in Paris in the recent months a few numbers of new development that will arise in the forthcoming years. I'm thinking, for instance, of the operation we made last year on a 15-story former office building with a building permit in place, and that will be redeveloped as one of the biggest cities in Europe, with a direct connection to Gare de Lyon. So yes and no. When it comes to Paris, it's definitely very hard to find a possibility to buy an asset, and furthermore, if coming from outside Europe, you could be finding our way to do business sometimes funny. So basically, making some development will avoid you to buy the going concern, the French going concern, namely the fonds de commerce, that is sometimes hard for external investors to understand. And at least you can write your own story, because you don't have that many hotels in Paris which are at the present time unencumbered and offer sufficient size when it comes to a hotel over 100 bedrooms. Just a small information is you've got only less than 5% of the hotel in Paris which are over 100 bedrooms. So that is giving you the amount of hotel that could be on the market, and the number of investors which are looking for this kind of asset.
Interestingly, yesterday one of the banks was saying to me that yes, they would like to do some development in the UK, but when you talk to them about where in the UK, it then becomes very target specific. If you talk to them about London, if you talk to them about Cambridge, or you talk to them about an airport, then it becomes of interest. As soon as you start going to the real UK, then it becomes more questionable. We funded at Topland, we funded 20 million for a new build Hampton by Hilton at City Airport. But would we fund the same Hampton if it was going to be in Swansea? Unlikely. So I think funding's available, but it's selective for development as to where the location is. It's always going to be with hotels, location driven, and also who the borrower is. Someone with a track record today of development of Premier Inns, travel lodges, they'll find that they'll get development finance. So I think it depends on what you're building, really.
Have we got any questions from the floor? No. Okay, I'll ask one more then. Does anyone feel that are there any markets, sectors, geographies where now is the time to sell, where we are potentially at the top of the cycle in Europe?
The UK.
Do you feel that?
Well, one of the things that we've acquired 28 hotels over 13 months, but if I look back now and what we paid for them, and we bought well, I'd like to think. Others may think otherwise, but I think we bought well. I think we've managed to do some turnaround on the businesses that we bought, and we've consolidated the platforms. So it's actually been not so challenging. Had a very, very good provincial market uplift. It's helped our business, buying well and then streamlining a business and operating it more efficiently leads to good EBITDA. Look at the multiples, and it would suggest maybe now's the time to sell. However, where would we invest? As a private family office, where would we invest the money and get the returns we're getting today? We can't replace that. So we've evaluated it, and we're not sellers, but one would think that if you're going to sell, you sell in the UK.
Carl, similar?
I would have to agree, yes. And I think it ties in, but the earlier comment about how long will the regional market continue to grow in terms of performance. I think that's a key component, as far as I can see it. And it will stop, and we've seen it before. And that's why I think a lot is happening. And you touched something like Malmaison and even Starwood Capital. They bought Principal Haley about 2.5 years ago. They're selling the Haley part. So to me, these are indicators, to me personally. No? So that's how I would see it.
You don't need to rush to sell London and Paris, because you're always going to be able to sell London and Paris. It's where you can capitalise on the market and the timing to sell the hotels that you would normally struggle to sell.
Yeah, I think another one is you have some of the former Mint hotels on the market, which, let's call it the more regional ones. To me, Manchester not regional, but that's how the term is. But one keeps the two in London and one in Amsterdam. So for me, it's another indicator to your point.
And selling them vacant possession, Carl. I find that one interesting as well.
Well, there must be a clause.
Yeah.
Bruno, you're not a seller in Paris, right? Well, but
as you mentioned, Paris is a good time to sell, and especially for small assets, because there is an incentive, a tax incentive for private French investors to buy a small hotel to try to diminish their tax burden. And basically, we've seen in the last 2 years this market to be really active on the asset of less than 20 million euro, which usually do not interest the biggest investors, because the size is too small, and we're talking of bedrooms which are under 50 in terms of room capacity. That does not interest a large hotel group. Yeah. So that is also a very good momentum.
Any thoughts or questions from the floor? No? Okay.
We're getting an easy ride.
Well, I think time is probably up. So thank you, panelists, and thank you everyone for being here.